Something is happening right now that most people who own gold and silver, or who've been thinking about buying, have never seen before. And if you don't understand what it means, you could be making a very costly mistake by doing nothing. Precious metals dealers across the country are shutting down new orders before the market closes heading into the weekend. Not all of them, not permanently, but enough of them, and in a way that tells a very specific story about what is happening beneath the surface of this market right now. This video is going to explain exactly what's going on, why it matters far more than the mainstream financial news is letting on, and what the people who understand how this market actually works are doing about it right now, quietly, methodically, and without saying a word to the mainstream press. Let's start with the obvious question. Why would a dealer shut down orders? Think about that for a second. These are businesses. Their entire purpose is to sell you something. Dealers don't close their doors and turn away revenue unless there is a very compelling reason to do so. And when you understand that reason, everything else starts to make perfect sense. Here is what happens in the physical metals market on a Friday afternoon heading into a weekend. The spot price of gold and silver, the number you see quoted on every financial website, is derived from the paper futures markets, COMEX in New York, the London Bullion Market Association, or LBMA, across the Atlantic. These are markets where contracts representing enormous amounts of gold and silver change hands every single day. But here's the critical part that most people never think about. The overwhelming majority of those contracts are never settled in physical metal. They are speculative positions, paper bets. They exist in a world entirely separate from the physical ounces sitting in a vault or shipping out to a customer's front door. Now, when those markets close for the weekend, the price discovery mechanism essentially goes dark. From Friday afternoon until Sunday night, when Asian markets open, there is no official price being set. But the world doesn't stop. Geopolitical events don't pause for weekends. Central bank decisions don't wait until Monday morning. News breaks. Crises escalate. And when a dealer has committed to selling you a 1-ounce gold coin at today's spot price plus their premium, and then over the weekend the price surges dramatically, that dealer takes a significant loss. They sold you the physical metal at a price that was set before the weekend move, and now they have to replace their inventory at the new, higher price. This is what dealers call gap risk. And in a market environment where price volatility has become the defining characteristic, where the metals have moved in ways that have genuinely shocked even the most seasoned analysts, gap risk is not a theoretical concern. It is an existential one for a small or medium-sized dealer. So when you start seeing multiple dealers simultaneously pulling their order books before the weekend close, what they are really telling you, without saying it directly, is that they are scared of what Monday morning looks like. And historically speaking, when the people who make their living knowing this market are scared of what Monday morning looks like, you should be paying very close attention. Now let's zoom out, because what is happening with dealers right now doesn't exist in a vacuum. It is the visible surface of a much deeper tectonic shift that has been building for years and has now reached a point where even ordinary mainstream Americans are starting to feel its effects without fully understanding what is causing them. Think about what has happened to the purchasing power of the dollar over just the past few years. The things that every American family needs, groceries, gasoline, electricity, housing, have become dramatically more expensive. This isn't happening by accident. It is the predictable, mathematically inevitable result of what happens when a government and its central bank create too much money chasing too few goods. The technical term is monetary inflation. The real world result is that your savings, sitting in a bank account earning next to nothing, are quietly being destroyed every single day. And by the way, I put together a completely free guide that goes into exactly how thousands of American retirees are protecting their hard-earned wealth in this environment. It's in the description below. It covers the saving strategies that have historically held up even when everything else was falling apart. If protecting your retirement is on your mind, it's worth checking out before we go further. Now, back to what's happening in the market, because the story gets considerably more interesting and more urgent. To understand why dealers shutting down orders before a Monday matters so much, you have to understand the structural tension that exists right now between the paper gold and silver markets and the physical market. This tension has been building for a very long time, and there have been moments throughout history when that tension snapped, and snapped violently. Let me take you back to a moment that most people in mainstream finance would rather forget. In the late 1970s and into 1980, two brothers from Texas named Nelson Bunker Hunt and William Herbert Hunt had accumulated a massive position in physical silver. They understood something that the paper market participants either didn't understand or refused to acknowledge: that real physical silver was genuinely scarce, and that the paper contracts claiming to represent silver were wildly inflated beyond the actual available supply. Silver went from around $6 an ounce at the start of their accumulation to over $50 an ounce in January of 1980. That is a gain of more than 700% in just a few years. The exchanges and regulators eventually stepped in, changed the rules mid-game, increased margin requirements specifically to break the Hunt position, and silver collapsed. But the lesson of the Hunt brothers isn't about their failure. The lesson is about what they had figured out. When there is a genuine disconnect between what the paper market says something is worth and what you can actually get your hands on in the physical world, the physical market eventually wins. Always, without exception. The price always gravitates toward the reality of actual supply and demand. And here is where that history connects directly to what is happening right now. Central banks around the world, particularly those in the East, in Russia, China, India, Turkey, and across the BRICS coalition of nations, have been accumulating physical gold at rates that, in some cases, are the highest on record. These are not retail investors. These are the treasuries of sovereign nations. They don't buy gold to speculate. They buy gold because they understand something about what is happening to the global monetary system that most Western retail investors have not yet processed. What they understand is this: we are living through a period of deliberate, accelerating de-dollarization. The global financial system that was built on the foundation of the US dollar as the world's reserve currency is undergoing the most significant restructuring in decades. BRICS nations, representing billions of people, are actively developing alternative trade settlement mechanisms that bypass the dollar entirely. Countries that once held their foreign currency reserves almost entirely in treasury bonds are diversifying aggressively into physical gold. And when a central bank buys gold, they are not buying an ETF. They are not buying a futures contract. They are taking physical delivery of real metal and placing it in their own vaults under their own control. In just the first quarter of this year alone, central banks globally added hundreds of tons of physical gold to their reserves. That is not a rounding error. That is a structural shift in how the world's largest financial institutions are thinking about the future of money. Now layer onto that the geopolitical reality we are living in. The US-Iran conflict has sent energy prices surging dramatically, driving inflation back upward just when many people thought the worst was behind us. Inflation at 4.2%, driven largely by energy, means the Federal Reserve is boxed into a corner. Lower rates and inflation accelerates. Raise rates, and you risk triggering the very credit market collapse that policymakers have been desperately trying to avoid. There is no clean answer here, and precious metals have historically been one of the only asset classes that performs well in exactly this kind of environment. Stagflationary pressure, geopolitical uncertainty, and currency debasement all happening simultaneously. Let me tell you about another moment in history that has eerie parallels to what we are experiencing right now. In the summer of 2008, in the months before the financial crisis fully erupted, there were people watching the physical gold and silver markets with growing alarm. On paper, in the futures markets, prices were relatively orderly, but in the physical world, premiums were beginning to spike. Dealers were reporting unusual demand. Coin shops in major cities were selling out of American Eagles and Maple Leafs faster than they could restock them. Wait times for delivery stretched from days to weeks. The people paying attention to those signals, the physical premiums, the inventory shortages, the extended delivery times, were getting a warning that the paper market wasn't giving them. And when Lehman Brothers collapsed that September and the true depth of the crisis became visible to everyone, gold surged dramatically, while everything else fell apart. What you are seeing right now, with dealers shutting down orders before a Monday, is that same kind of signal. It is the physical market, the real world of supply and demand, of actual metal in actual vaults, telling you something that the paper market hasn't fully priced in yet. When the gap between paper price and physical reality widens enough, the paper price eventually has to come up to meet reality. That reckoning has happened before. It is happening now. Here is something else that most people watching precious metals have never considered. The mechanics of the COMEX futures market create a structural vulnerability that becomes critically important in exactly the kind of environment we are in right now. On the COMEX, the ratio of paper gold contracts to the actual physical gold available for delivery has, at various points, been extraordinarily high, meaning there are many, many more claims on physical gold in the paper market than there is actual physical gold to back those claims. As long as most contract holders are content to roll their positions rather than demand delivery, this works. The moment a meaningful percentage of contract holders decide they want the actual metal, not the paper, not the cash settlement, but the physical ounces in their hands, the math stops working. The system cannot deliver. And when systems built on leverage and paper claims cannot deliver, what typically happens is a violent price adjustment. The London Bullion Market Association faces the same structural tension, but on a larger scale. The LBMA facilitates an enormous volume of unallocated gold trading, meaning the buyer doesn't actually own specific physical bars, they own a claim on the pool. This has worked for decades, but as more and more sophisticated buyers, central banks, sovereign wealth funds, large family offices, have shifted from unallocated to allocated holdings, demanding specific numbered bars in named vaults, the system has come under increasing stress. Goldman Sachs, JP Morgan, and Morgan Stanley all currently have year-end price targets for gold that are substantially higher than where we are trading right now. These are not permeable gold bugs. These are mainstream institutions with enormous analytical teams. When every major Wall Street bank is in the same camp, projecting significantly higher prices, that consensus deserves serious attention. And silver, the most misunderstood metal in this entire conversation, may be the most compelling story of all. The gold to silver ratio right now is sitting near a level that historically has preceded some of the most explosive silver price moves on record. Think about what that ratio means. If you need a certain number of ounces of silver to buy 1 ounce of gold, and that number is historically elevated, it means silver is cheap relative to gold by historical standards. It's not that silver is expensive, it's that silver hasn't caught up yet to where gold has already gone. Every single time in modern financial history that the gold to silver ratio has been at this kind of elevated level, silver has eventually closed the gap. Not gradually, not orderly. Silver closes gaps violently, quickly, and in a way that rewards the people who were patient enough to accumulate before the move rather than after. And here's what makes silver's story even more compelling than most people realize. We are not just talking about silver as a monetary metal, as a store of value, as a hedge against currency debasement. Silver has an enormous and rapidly growing industrial demand story that gold simply doesn't have. Every solar panel manufactured requires silver. Every electric vehicle requires silver in its electrical systems. Every advanced semiconductor, every 5G antenna, every medical device. The green energy transition that governments around the world are spending trillions of dollars trying to accelerate is fundamentally dependent on silver. The same metal that sat in jewelry boxes and coin collections is now an absolutely critical industrial input. And unlike gold, where a significant portion of demand can be satisfied by recycling existing above-ground stock, silver is consumed, used up in applications where recovery is economically impractical. The Silver Institute's data shows that industrial demand for silver has been hitting record highs consistently. Mine supply, meanwhile, has not kept pace. You cannot simply turn on a silver mine when prices rise. The lead times from discovery to production are measured in years, sometimes decades. This is a structural supply-demand imbalance that has been building quietly, while most investors were focused on tech stocks and cryptocurrency. Now, I want to talk directly to those of you watching this who have significant assets in retirement accounts, because this is where the rubber really meets the road, and this is where I think the stakes are genuinely highest. If you have worked for decades, if you have saved carefully, if you have followed all the conventional advice and built up a nest egg in a 401k or an IRA, you are sitting with an enormous amount of exposure to the paper financial system, to stock markets, to bond markets, to the monetary policies of a Federal Reserve that is operating in uncharted territory. And what we are watching unfold right now, the de-dollarization, the geopolitical realignment, the structural debt levels, the inflation that keeps coming back despite everything, is precisely the kind of environment that conventional retirement portfolios are least equipped to handle. This is exactly why the concept of a gold IRA was created, not as a speculative play, not as a way to try to get rich, but as a hedge, a way to take a portion of your existing retirement assets and convert them into physical gold that is held in your name, in an insured, audited, IRS-approved depository. You get the tax advantages of a retirement account combined with the wealth preservation properties of physical gold. The setup process is much simpler than most people realize. It typically involves a straightforward rollover from your existing account with no tax penalty. And for someone sitting on $100,000 or more in retirement savings right now, it is worth an honest conversation about whether this makes sense for your situation. Check the description below for the free guide. It covers exactly how this works, what to ask, what to watch out for, and how to figure out if it's right for you. Back to our dealers shutting down orders before Monday. Let's talk about what is actually happening in the supply chain right now, because the signals are layered on top of each other in a way that should command serious attention. When dealers pause orders, they are responding to what they are seeing in their own inventory, in the wholesale market for physical metal, and in the premiums they are having to pay to acquire additional stock. When those premiums, the price above spot that a dealer pays to source physical ounces, start to rise significantly, it tells you the demand for real metal is outpacing the ability of the system to supply it at current paper prices. We saw this dynamic play out vividly in the early months of the pandemic. COMEX spot prices were trading at one level. Physical dealers were charging dramatically higher premiums. In some cases, American Silver Eagles, the most liquid retail silver coin in the United States, were trading at premiums that essentially doubled the effective price relative to spot. If you called 10 dealers, several of them would tell you they were simply out of stock and didn't know when the next shipment was coming. That disconnect between the official paper price and what you actually had to pay to get real physical metal in your hands was a preview of what happens when the market's illusion of infinite paper supply runs headlong into the very finite reality of physical production and distribution. The fact that we are seeing dealers take precautionary action again right now, heading into a weekend where the geopolitical situation remains fluid and unpredictable, where inflation is re-accelerating, where institutional money continues to flow aggressively into physical metal, that is not noise. That is signal. Let me give you the bigger picture one more time, because I want this to land clearly. We are in a period where the financial system is dealing with simultaneous stresses that individually would be significant, and together represent something genuinely unprecedented in the modern era: geopolitical conflict and energy market disruption, inflation that refuses to stay dead despite everything the Fed has tried, national debt levels that have moved beyond the point where traditional monetary policy can solve them without inflicting serious pain somewhere in the system, de-dollarization accelerating as BRICS nations build out alternative financial infrastructure, central banks globally signaling their lack of confidence in paper currencies by accumulating physical gold at historic rates. Every one of these factors individually has, throughout history, been associated with periods where gold and silver dramatically outperformed every other asset class. The person who owned physical gold during the stagflation of the 1970s didn't just preserve their wealth, they multiplied it. The person who owned physical silver in the months before the Hunt Brothers squeeze didn't need anyone to tell them that the market was mispriced. The person who held physical metals through the 2008 financial crisis watched in real time as the system that everyone had been told was safe, the banks, the mortgage securities, the financial engineering that was supposed to eliminate risk, revealed itself to be something far more fragile than advertised. History does not repeat perfectly, but it rhymes with a consistency that should make every thoughtful person sit up and pay attention when the patterns start to align. Right now, the patterns are aligning. The dealers who are shutting down orders before Monday are not panicking. They are professionals. They are risk managers. They are people who have made it their business to understand what this market is telling them. And what they are telling you through this action is that the risk on the other side of the weekend is elevated in a way they are not comfortable absorbing. For the investors in this audience who have been waiting for the right moment, for the right confirmation, for the market to give you a clear enough signal, this is a signal worth paying attention to. For the retirees and near retirees watching this, who have built up retirement savings they cannot afford to lose, who have watched inflation quietly erode their purchasing power while their bank accounts earn almost nothing, who have been hearing about gold and silver and wondering whether it's too late or whether it even applies to them, I want you to hear this clearly. The protection that physical gold and silver offers is not about making a speculative bet that prices go higher in the next 6 months. It is about recognizing that the monetary system you have relied on for your entire working life is under unprecedented stress. and that the asset class that has preserved purchasing power across every major currency crisis in recorded human history is sending you a very clear message right now. And it is sending that message through the very visible, very concrete action of dealers choosing to step back rather than expose themselves to a Monday morning they can't fully predict. If you watched this entire video and you take nothing else away from it, take this. The physical market is always more honest than the paper market. The paper market can be extended, manipulated, leveraged, and papered over. The physical market cannot. When the physical market speaks, through premiums, through inventory shortages, through dealers making the business decision to pause rather than commit to prices they don't trust, you are getting a signal from reality itself that is worth more than any analyst target or financial media headline. The free guide in the description covers everything I've discussed today in much more detail. The mechanics of physical metals, how dealers actually operate, what the central bank accumulation data really means, and specifically how the saving strategies that thousands of American retirees are using to protect their wealth work in practice. It is completely free and there are no strings attached. And if you have watched this video all the way through, which tells me you are someone who takes this seriously, I want to offer you something beyond the guide. For American retirees who have at least $100,000 in any retirement account, we are making available an exclusive, complimentary one-on-one educational web conference with no obligation whatsoever. This is not a sales call. It is a personalized conversation about your specific situation, your specific concerns, and whether the strategies we have talked about today actually make sense for where you are in life. The only way to access this offer is to mention that you watched this video when you reach out through the link in the description. The dealers shutting down orders before Monday are doing what professionals do when they see something that concerns them. They get cautious. If the people who make their living in this market are getting cautious right now, maybe it's worth taking a few minutes to think about whether the level of caution in your own financial life reflects the environment we are actually living in. Stay informed, stay protected, and pay attention to what the market is trying to tell you.